Welcome back, everyone. This is our Gold Weekly Review. My name is Angelo Zittis, and this week's title is Gold Continues to Conquer Higher Grounds. Gold steadily continued its way higher in the past sessions as the economic circumstances around the world seem to support its price. After some significant developments in the past days and even today, gold traders don't seem willing to give away their long positions as the precious metal has been lifted to a new 9-year high. This report aims to review some of the most important fundamental drivers for gold's price at the moment, and a conclusion will be provided at the end, expressing our own views on where gold could be heading. Yesterday, the Washington Post gave information on the new fiscal stimulus package currently being prepared in the US. The Treasury Secretary, Steven Mnuchin, stated they are looking into a $1 trillion package that would be aimed at improving employment, funding a COVID-19 vaccine, and most importantly, reopening schools. Also, President Trump is in favor of a payroll tax cut that would support businesses to employ more people or keep jobs going. The news provides a positive outlook for the U.S. economy that could regain substantial ground lost during the pandemic. However, with the rather large fiscal package the White House is planning to release, we could see the USD weakening further as the extensive money supply continues. According to the dollar index that monitors the greenback against other major counterparts, USD has been weakening in consecutive sessions lately, and the happening tends to support gold's price. In our opinion, the use of extensive money supply creates serious risks for the long term in an economy, and especially for the US that is known to keep a rather large national debt. According to other sources, the US national debt reached a record of $24.22 trillion in April 2020 and could increase further by year end. On the other hand, the federal budget deficit for fiscal year 2020 is projected to top $3.7 trillion and could also increase by year end. Even though the majority of market participants may not be paying attention to these figures or risks, from our point of view, instruments sensitive to financial risk, like gold, tend to appreciate in these circumstances. The safe haven qualities gold carries have come into play during the past year, but more specifically in the past 4 months since the start of April. Then again, another stimulus recovery package was agreed upon today by the EU. The EU agreed on a 750 billion euro recovery fund, where 390 billion should be non-repayable grants, down from 500 billion initially proposed, and the rest in repayable loans. As the announcement was made in the early European morning, gold has surged approximately $10 since the deal has been announced. So we could be seeing gold traders making use of any information regarding further stimulus additions or actions. Moreover, as in all our previous reports, our aim is to provide a heads up for events that could move gold's price and possibly caution traders. On the 22nd of July, we get the US existing home sales for June, while on the 23rd, we get the weekly US initial jobless claims figure. Finally, on the 24th of July, we get the US Market Composite Services and Manufacturing PMIs for July, along with the US new home sale units for June. As a conclusion, our opinion is that gold could be technically ready to correct lower, but the fundamentals surrounding the drivers of its price, which have been mentioned in this report, seem to tell us exactly the opposite. At the moment, gold is trading approximately 6% away from the all-time high price of 1921.17, which was seen back in 2011. Yet, with the actions planned by governments and central banks globally for the year ahead, where is gold heading? Moving now to our technical analysis, this is gold's 4-hour chart. Now, gold remains in an upward trend as it has broken above the S1 1818 support level and has reached a 9-year high today in the European morning, as mentioned before. If the precious metal is to continue its ascent higher, then the first level to be tested, in our point of view, is the R1 1830 line, and even higher we have noted the R2 1840 hurdle. In the ultimate bullish scenario, we also noted the R3 1850 line as a possible target. Please note, gold has not traded at these levels for many years, so traders may be looking for round number levels. Yet, if traders start selling the metal, it could fall back and retest the S1 line as noted before. In case a force correction is implemented and gold moves even lower, we have also noted the S2 1810 level that was last seen yesterday. Even lower, we have also noted the round number S3 1800 level as a probable stop point. Please note the RSI indicator below our chart is running above the 70 level, possibly confirming the bullish run is still in place. Now, if you've heard something in this report that you found useful, make sure you apply it to your trading. That's the whole point. Thank you very much for your time. And from me, Angelo Zittis, and from everyone here at IronFX, we wish solid trading.